Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. Nvidia, sell the news. $260 billion erased despite record Q4. 2. PBOC scraps FX reserve ratio to cool Yuan rally. 3. Tokyo core CPI drops below BOJ, 2% target. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. Nvidia, sell the news. $260 billion erased despite record Q4. Primary asset classes impacted: U.S. equities, S&P 500, NASDAQ 100, semiconductors, AI hardware, U.S. Treasuries, 10Y, volatility indices. What happened? Nvidia reported record Q4 FY 2026 revenue of $68.13 billion, plus 73% YOY, and EPS of 1.56, both ahead of consensus. Data center revenue reached $62.3 billion, plus 75% YOY. Despite the beat, the stock fell 5.47% on the session, wiping roughly $260 billion in market cap as investors questioned how long AI capex can sustain current growth rates. Why it matters. This is a textbook sell the news event after an extended AI-driven multiple expansion. It signals that markets now require visibility on 2027 earnings and margin durability, not just headline growth. The move dragged the S&P 500 and NASDAQ 100 lower and coincided with a drop in the U.S. 10-year yield toward 4.02%, indicating a partial rotation into duration and quality. The reaction sets a new bar for the entire AI complex, with downstream names likely judged more on profitability and real cash returns than on top-line AI narratives. Key numbers to remember. Q4 FY 2026. Revenue $68.13 billion, plus 73% YOY. Data center $62.3 billion, plus 75% YOY. Share price minus 5.47% on the day. About $260 billion in market cap erased. S&P 500 minus 0.54%. NASDAQ 100 minus 1.16%. US 10-year yield near 4.02%. What to watch next? Focus on Nvidia's March GTC event for details on the Rubin architecture and any acceleration of its product roadmap. Watch whether the roughly 4.5T market cap area and the 12-week moving average around 188 hold as key supports. Upcoming earnings from hyperscalers and AI infrastructure providers will indicate if capex plans are plateauing or still expanding. A clear slowdown in AI capex guidance could trigger a broader derating across high multiple semis and growth tech. 2. PBOC scraps FX reserve ratio to cool Yuan rally. Primary asset classes impacted: FX, USD/CNH, USD/CNY, DXY, EM equities, Asian credit, commodities. What happened? The People's Bank of China announced it will cut the foreign exchange risk reserve ratio on forward forex sales from 20% to 0%, effective early March. This reverses a 2022-era tightening tool originally deployed to curb yuan weakness. Following the announcement, USD/CNH jumped around 0.3% toward the 6.86 area as markets priced a clearer policy preference against further rapid yuan appreciation. Why it matters. The move is a strong signal that recent yuan strength has moved beyond the PBOC's comfort zone. After more than 6% appreciation versus the dollar over the past year, and a decisive break below 7.00, Authorities are now lowering the cost of buying dollars via forwards, effectively encouraging hedging and slower currency gains. In the context of new 10% U.S. tariffs and persistent trade uncertainty with Europe, a more competitive exchange rate is a key policy lever to support exporters and manufacturing. This has direct implications for EMFX, Asian credit, and commodity demand expectations. Key numbers to remember. FX risk reserve ratio cut from 20% to 0% on forward sales. Roughly 6% Yuan appreciation versus the dollar over 12 months. USD/CNH moving towards 6.86, about plus 0.3% after the announcement. What to watch next? Watch the USD/CNH behavior in the 6.85 to 6.90 band over the next couple of weeks as the first test of policy effectiveness. Persistent Yuan strength despite the change could push the PBOC towards stronger tools, such as more aggressive daily fixings or moral suasion on state banks. Monitor flows into Chinese equities and bonds for signs that a weaker currency path is supporting risk assets. The broader dollar trend will be important. Renewed dollar strength would reduce pressure on Beijing, while a softer dollar would force China to work harder to manage the pace of yuan appreciation. 3. Tokyo Core CPI drops below BOJ 2% target. Primary asset classes impacted. Japanese equities, Nikkei 225, Topix banks, JGBS, USD/JPY, global carry trades. What happened? Tokyo Core CPI rose 1.8% year-on-year in February, down from 2.0% in January and the lowest pace since late 2024, slightly above expectations. The core measure excluding food and energy also slipped to 1.8% from 2.0%. At the same time, Japan's industrial production increased only 2.2% month-on-month, far below the 5.5% consensus, hinting at softer real activity momentum. Why it matters. Core inflation falling below the Bank of Japan's 2% target reduces immediate pressure for additional rate hikes and supports the narrative that recent price strength is moderating. With inflation easing for several months and political backing for a cautious stance, markets are reassessing the timing and magnitude of further normalization. This favors continued accommodative conditions, supporting Japanese equities and maintaining attractiveness of yen-funded carry trades while limiting upside in long-end JGB yields. However, the still positive underlying price dynamics mean the BOJ cannot fully pivot back to an ultra-dovish posture. Key numbers to remember. Tokyo Core CPI, 1.8% year-over-year versus the 2.0% target. Core CPI also at 1.8%, down from 2.0%. Industrial production plus 2.2% month-over-month versus 5.5% expected. What to watch next? Key dates are the upcoming BOJ policy meetings in March and April, where updated forecasts and guidance will refine the market's rate path expectations. If national CPI follows Tokyo lower, pricing of further hikes may shift into the second half of the year. Watch Nikkei performance near recent record highs and USD/JPY behavior around the mid-100s and 50s as gauges of risk appetite and carry positioning. Any unexpectedly hawkish comments from BOJ leadership could quickly reprice yen and JGBs, challenging crowded short yen trades. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.